session. So hello everyone. Firstly, I would like to thank all the participants for taking the time out from their busy schedule and joining in today. Again, it's a very special day because with me I have Mr. Anil Rego from Right Horizons. So we kind of invited him and we thought of interacting with him and try and understand that how do they manage funds. And so I can see that there are a good number of people who joined in and some of them are joining in. So in the meantime, I'll just give you a little bit of introduction about myself. So my name is Vikas Agrawal and I'm the founder of AIF and PMS Experts India. So basically we are a digital platform for alternate investments and portfolio management services. And we've kind of tied up with Right Horizon as well for distributing their offerings. So I'm in touch with him. I happen to know Anil ji for over 1 decade now, almost more than 10 years. And in fact, I was in Bangalore before and had a chance to interact with him and meet him in person, visited his office as well. And then I moved to Pune later. Anil brings about more than 2.5 decades of experience in terms of investing in equity markets. And before that, he used to work for Wipro. In fact, he began his career in the IT sector and then eventually moved to financial industry. So he's completed his CFA and he's also MBA, and he brings about almost 25 years of experience. So let me welcome him officially and formally. Welcome to the show of Ask the Expert, Anil.
Yeah, thank you, and I'm happy to be on the show, and thank you for inviting me over.
Thank you. So basically, Anil, we run this show called Ask the Expert at AIF and PMS Experts India, and the whole idea is to invite industry experts like you yourself. You're the CEO and also a CIO of your organization, and you've been investing in equity markets for many years. I mean, you probably would have seen Wipro and Infosys at their 100 crores or 200 crores of valuations those days. During your time when these organizations were growing. So we thought of inviting you, and we thought we'll try and understand more about your thought process, your organization, Right Horizon, because you are into portfolio management services as well. And we also try and read your minds and understand what's the outlook of equity markets. So these are the few things that I wanted to basically talk about. And also, as we grow, as the session move forward, we'll also understand more about what sort of process that you follow in your organization and what really helps you to kind of outperform on both the sides. So that is bringing me to my first question. So what we do is at AIF and PMS Experts India, we keep a track of the performance of various portfolio management schemes. And one of the observations that I had as an outsider is that I saw that you always follow contrarian way of investing. And I saw that even when during the COVID time when market fell down by almost 25-30%, I saw that your funds did not go down to that large extent. And while the market was bouncing back, I saw that it also created good amount of alpha on both the sides. So while it protected the downside risk, at the same time, it created good amount of alpha. So my first question to you is, how do you manage to do so? That's the first question.
Normally, I tell my clients, we take a lower risk. So at a trending time, you'll probably see lower returns as well. Okay, even though the effort is always, to try and deliver on both sides of it. I think part of it is because of, one's whole maybe experience that comes behind of market cycles. And so that is something that one brought to the table. So interestingly, why did we fall lesser, in the COVID fall? Actually, if you go back and see, most PMSs fell more than the index, okay, because they were taking a higher level of risk. They were trying to deliver a higher alpha, so they ended up falling more. So we felt actually lesser than the index. And so why did that happen? That actually happened because in October to December of 2019, okay, somewhere I got uncomfortable with market valuations, and we took various measures. We took a cash call, we increased cash, we reduced financials in our portfolio. We also, ended up investing in pharma. Interestingly, two companies that we invested in pharma both benefited from the COVID period. Okay, so that was something which helped us we also went a little bit defensive, even in terms of the stocks, the consumer stocks, etc. And our fall was thus lesser. What we did on the fall, again, we looked at it and looked at market cycles and felt that at least I look at sentiment indicators as well. So the sentiment indicators, showed me that there was already fear on the street. So I thought, the turning point is closer. So when markets ended up actually falling, we went and redeployed that money and we went back into higher risk. Okay, so that helped us to sort of get back, and we participated in the rally which sort of followed. And the good part is, we were able to deliver a substantial alpha with the upside. And that possibly also has to do with our stock picks and the process, because we try to find those stocks which also can become future leaders. And some of the stocks that we picked ended up doing very, very well, and they just got discovered, and so that helped us deliver a little bit of an additional alpha apart from just the market cycle.
Sure. I can see some participants are raising their hands. So in case you have any questions, please put up your questions in Q&A box, which is on your right-hand side of your cell phone or desktop if you're using. And once this conversation or presentation is over, we'll straight away come to you and start taking your questions. So thank you so much for your patience. Yeah, coming back to the first question, and you talked about risk-adjusted return. So what do you mean by risk-adjusted? I see that your organization emphasize and focus more on risk-adjusted returns, and at the same time you have a contrarian approach. If you can throw lights on both the subjects.
Yeah, so the whole point is, and my experience over the period and the number of years that I've been investing, okay, is that risk and return go together, right? And interestingly, what I feel is if you manage risk and you are in the right assets and allocation is right, return will automatically come. Okay, so for me, while in fact both on the wealth and the fund side, many times clients come back and say, okay, what's the return that you are able to deliver? Okay, but very rarely you find them coming back and saying, okay, how do you manage risk? Okay, and I think that differentiates. So if you're able to manage risk and you're in the right places at the right time, then you'll also see the return automatically come in, and you will not be able to imagine the additional return because of a lower fall. Okay, so and what it does is, as an experience for you as an investor, you're not in a roller coaster ride, right? And that was very, very important, and that was my style of investing. I was also contrarian. It's like this. It's not as easy, and I'll give you an example of gold, right? So in fact, in on our flexi-cap portfolio, which allowed us to have it, we even invested in gold and we got out of it. It gave a phenomenal, 60-odd% return. Okay, and for a reasonably short period of time. So, but when we invested is when everybody had got completely frustrated for investing in gold, right? So similarly, you may find even the sectors and stocks, you may find that we sort of turn around and look at them differently. Like the pharma was an example. Again, people were very frustrated with the sector when we started investing in it. Okay, so we're saying that risk and return together, and so our point is, in the long run, we think that it'll deliver a better return as well. And our philosophy is that we look to deliver superior risk-adjusted return. Okay, the second aspect of delivering the risk-adjusted return is how we manage it. We do it through a risk management methodology. So there's a very well defined methodology we follow for ourselves, and a structured investment process. Okay, and the structured investment process also in some ways helps us not to make some of those mistakes, right? That we may take an emotional call about. Okay, and of course the last is we look at fundamental and quantitative analysis. Okay, framework. So most of the time the decision to make a move or something like that is based on some data. So if I move between mid cap and large cap, it is because I'm looking at relative valuation and not just taking a call just like that. Okay, so that's our view, and so our whole point is how do I deliver a much more peaceful experience for our clients through more stable and consistent return, and which is what we call it as risk adjusted return.
Yeah, great. So one is you look at the risk adjusted return, at the same time you follow a sort of contrarian approach, and kind of see to it that the risk and return goes hand on hand. So that's an interesting point. So other thing which I wanted to talk about is what sort of process that you follow in your organization in terms of managing funds. And also if you can talk to us about your team members, and also talk to us about your small cap fund, because we saw that in the top 10 PMSs of the industry, one of your PMS is your small cap PMS. So over to you.
Yeah, so actually, interestingly, 2 of our funds are the top 10, okay, that came out in Economic Times, okay. So I'll take your permission to just share my screen, because I think, people will be able to relate, better to it.
Yes.
Yeah, are you able to see my screen?
Yes.
Yeah, wonderful. Okay, so our whole investment process, and I spoke to you about our philosophy, right? Is about delivering a superior risk-adjusted return through a robust risk management methodology and a structured investment process, and looking at in-depth fundamental and quantitative analysis framework. Yeah? So, and that sort of is embodied in everything that we do. Okay, so we have broken up our process into 4 parts. One is a screener, okay, where we screen companies out of the whole universe and come with a smaller set of 100 plus type of companies that we can then drill down further. Okay, I'll spend time on each of them. Then we look at the scorecard. Okay, the scorecard is a way to, in fact, we rank each of these companies which come in our screener. Okay, and then we say, based on the ranking which come on top, that also gives us a framework to look at some of these. And the scorecard is much more across multiple parameters. We give weights to each area and stuff like that to come to that. Our risk radar is the third process, which sort of it underlying both at the time before we invest in a stock. We do a bit of a forensic analysis, as well as in a continuing basis. And the RH pendulum. RH pendulum is to look at stock is what is the time to buy, what is the time to sell, because the other thing that creates risk is if valuations are very high, right? So when we feel that valuations are excessive, then the pendulum sort of helps us look at that. So the screener is one where we look at the whole universe. We screen from a whole universe of companies. We look at long-term sales growth, long-term earnings growth. We look at the return on capital employed, or ROCE. Okay, and we have a few factors which we exclude companies, right? They include the debt equity ratios, and if they have pledged promoter holding above a certain value, etc. So those are some factors which we exclude. Okay, and so then there's a bit of a, we keep aside about 20% for ones which don't come through the screener. Okay, they could be because, example is auto industry, for example, was doing badly for some time, but then it turned around and was up, going up. In that period, you may find that the revenue growth and the profit growth may not fulfill the criteria. Similarly, pharma at some point of time, so turnaround. Okay, and we think that some which is sort of potentially disrupting, etc., where we sort of bring in, but we keep that restricted to about 20%. Okay, and so then we look at some of these, and we dive down to the next level. The next level is like what we say, a bit of a scorecard. So from the 100 companies or so that we come, within the screener, then the scorecard sort of looks at all of these factors, a combination of sales growth, the margins, the balance sheet items, okay, the return matrices. We do a forensic check, okay, because and before we touch a company from the screen, okay, we will do a forensic check, because what we've seen is if you find a company somewhere goes down, right, then the disruption to price can be very, very high. Okay, and of course we look at qualitative as well. we are trying to see who are the emerging leaders, right? The risk radar is a combination of, looking at it at the time we buy, okay, and we look at a whole lot of frameworks, okay, right from, some of them are just beta and, some of those other measures, okay, but we look at liquidity, some factors, like I said, at the forensic time, before we invest, and after that we would continue to look for any changes. For example, if there may not have been a pledging by the promoter, but subsequently he does it. So that we do a combination of quarterly, wherever it is result related data, or even on a monthly basis, or even on a live basis, where they are live data coming in. Okay, and the last is the RH pendulum, which sort of looks at buying and selling. We look at from various factors, the cycles, the macro trends. We look at it from a technical standpoint. Also, we look at from a fundamental, are they looking very high there? Okay, and the the other part of it, of course, like I spoke to you about, looking at market cycles. I'll not spend too much of time on this, but the point is, if we are able to get this right, then the value that can be created is very, very large. Okay, because yeah. So about RH PMS, I just captured a few slides so that it's easier for people to correlate and stuff. Okay, and we spoke about you want to know about the team. We have a reasonable team, comprising of 2 fund managers apart from myself. We have 2 assistant fund managers. Okay, and we have research analysts. We almost have 10 different portfolio funds that we have. Of course, at any point of time, sometimes we keep some dormant. Okay, but we look at them at sort of different points of time, because my whole point is I wanted to look at risk by also having different strategies on the platform. Okay, so that is something that we've done. So this was a team, and yeah, I think that's broadly what you had asked.
Great. It's great to know about you and your team. And many congratulations. You've almost completed now almost a decade, I would say, more than over 9 years. So you've done a great job in terms of managing funds and able to create wealth for your investors. So many congratulations.
Yeah, thank you. So as a group, we have almost like 18-year plus thing, but we started the PMS a little later, and yeah, so we are almost hitting a decade of period out there for our PMS servicing.
Sure. So Anil, you have a book in story form of various experiences of yourself and investors. So any learnings you can provide us from the book?
Yeah, so in fact, I think maybe I have a slide on there. Yeah. So the book is Honey, I Lost All Our Money. Okay. It is in story form because what I try to do, I try to bring together the experience of so many investors, right? And the trigger point, I think, which is very relevant today and for people to keep in mind, okay, because the temptation is to get carried away, right? I'm not necessarily saying that I'm calling the top, but you have to be cautious, when things are trending and doing well. Okay, and this was, and the trigger point was this particular story where this client actually, was, we used to manage part of his assets, and he was, 50 plus. He was a CEO of a company in the past, and sort of he retired, so he had a lot of experience looking at all cycles and all of it. He had invested maybe some things in the past as well, and which not necessarily did well for him. And then he started investing in stocks. Okay, so he kept, and he used to keep on coming back to me and say, Anil, why do you hold cash in your portfolio? Okay, we used to manage stock stuff for them earlier. So why do you have cash in our portfolio? I said, sometimes cash may be the best performing asset, right? If markets are falling. Okay, but interestingly, he came to me one day and suddenly said, okay, you know what? I need some money, 2 crores. Okay, so I almost like, so I said, okay, what? I didn't ask any questions because I could see he was very tense. Went back and actually gave that money and subsequently asked him. And he told me, you know what? I invested in the F&O side. Okay, and in somewhere closer to 2008, he was not able to call the top of the market. He had gone short. Okay, and I mean, he did very well in the beginning, right? You made good money. Okay, when you invested more, yeah, good money. Markets make this to you. They think you are an expert, right? And when he thought he was an expert, market turned around. Okay, and fell very sharply. Okay, and he didn't again, close his short thing, and then he lost money beyond his capital, almost to the extent of 3 crores. He was able to manage some fixed deposits and stuff like that, and then we were able to help him on the other side. So the point I'm trying to make is, markets deliver great returns. They tempt you to do the opposite. Okay, and while whatever you do, I think look back and think that the other side is also yet to come. So manage money. Disciplined investing is what can deliver great returns. So I think look at your asset allocation, look at how much risk you can take, and then possibly look at long term, and you'll probably do very well.
Great. It's a great story, and it's always one should remember that discipline ultimately plays very, very important role in terms of investing. And somebody looks at quick money, and then they get into F&O side, what you said, and then go back and whatever they have stored for their family, they have to take out that money to repay this sort of loan. So very difficult situation, and that is one of the one of the reasons why we run this show is to kind of educate and empower the investor community as a whole, and we invite experienced people, veteran in the industry like Anil and other people. The idea is to read their mind and understand how do we create long-term wealth. So I think very well said, Anil. Great story, I think.
Yeah, thank you.
Yeah. So what we'll do is we'll open this forum now for question and answer, and we'll have more interaction. So you can turn off this presentation. And dear participants, if you have any questions, anything which you feel like, which you wish to know from Anil, either about markets or about any particular thing, please feel free to type in the question in Q&A box. In the meantime, I'm going back to Anil and asking this question. So Anil, what's your views, house views on the markets now?
Okay, so that's $1 million question. Right. So see, almost like 2019 itself, I came out with this view that this decade, I think, will be the decade of India. Okay. At that point of time, people are a little, wondering what's wrong with me, and there's many other countries which are doing well, and stuff like that. So, but I think from studying cycles and all of it, I think I thought that this will be a period which is India will do very well from various standpoints. So I continue to believe that we should do very well through this decade. Okay, but at the same time, I think that markets will be volatile, and it's important to manage risk. Okay, so from that standpoint, you're also seeing that after that initial runaway, you will find the falls also get a little larger, and one needs to be cautious. So in the intermediate period, we think that markets will do reasonably well with an upward bias. I still think that, for example, mid caps will continue to do well for a period. In fact, somewhere in 2017, we moved out of mid caps and moved into large caps. In fact, even in our PMS, we ended up taking out money from the mid cap portfolios. We started coming back in, about a year and a half back or so, in a phased manner. Okay, so that is something which has been our philosophy, and we believe that we are in the midway of, let's say, the whole mid cap rally. And in this period, you could also see that excessive happens on both sides, right? So on the positive side also, maybe things could go crazy, and people wonder what's wrong with valuations, and that will sort of continue for a period of time.
Okay, so you feel that this decade belongs to India?
Yep.
Okay, great. All right, so last question from my side. Okay, there are a few questions which has come up. Okay, the first question is too much of volatility in Indian markets compared to other countries. Why so much?
So I'll give you an example that normally, if you look at mid cap and large cap stocks, right? So large cap stocks will grow sturdy, right? But they are in the long term, you may find their returns also may be lower. Okay. So similarly, I think India is a mid cap country, if I must say, right? So you will find, the more developed economies may deliver a steady return and may not be as high in terms of long-term return. Okay, but they also fall down lesser. And I love it when there's volatility. Okay, because actually you can make better returns, right? So it's something which if you're a contrarian by nature and stuff, actually you can benefit from the cycles. So you, I think, need to sort of keep it in mind, that India is a little bit more of like a mid-cap country, okay, and it'll be higher risk, but it'll also be higher return, okay. But there could be periods when you also need to be careful about, because at that time the falls can be very large, right? It's not unusual for us to have seen large falls of 40 to 60%. In fact, a full-blown market fall in India is of that size, and we've not seen anything close to it, right? We've not seen the 2-3 level falls that happen. So we've seen possibly a 1 level fall, and luckily markets recovered from there. So the bad news for you is there could be more to come, when markets fall. So that's where you have to manage risk a little.
Sure. I think Dilip ji is asking that would you be able to share the presentation, copy of the presentation? The answer is yes. Post this session is over, I'll have this sent to you. The next question is, how often your team, okay, that's the question which I'm going to ask you next. My question here is, so Anil, you also mentioned that there are 2 PMSs which are sort of now, as per your economic times, has emerged as the best portfolios. Can you throw lights on your small cap PMS as well?
Yeah, so we have actually I'll talk about both the mid cap and small cap. Okay, we have super value, which is a mid and small cap type of PMS, but mainly mid cap oriented if I look at on the overall, because you may have a little bit of large cap as well, so that balances out. Okay, so that is the super value. Comes through this whole process oriented, like what we spoke of, and that's a fund that I manage, with my team of assistant fund managers. Okay, so that so we look to deliver a risk-adjusted return on the mid cap side. The other one that we have is the RH underserved. Okay, so apart from the RH super value, so RH underserved is managed by Mr. Piyush Sharma. He's another fund manager on our platform. Okay, and so he looks for including small cap and maybe even micro cap. And the advantage sometimes we have on the on RH PMS is that the fund size is not large, so we can actually afford to look at some of these names which without too much bother about being able to exit them due to volume being available there. So from that standpoint, we are able to do some of the mid and micro cap. Piyush again looks at a deep value, studying the companies in detail. He also does a forensic. So the broad parameters are in place, but we like to give clients also a different flavor. He is a very, very low churn type of portfolio. So that's on this, underserved, which is a small cap side. Okay, and so he could, even hold stocks for a very, very long period of time, not trying to even react to market movements in between. Okay, so when the value unlocks, they could really, really do well. Okay, and you may find that something that is completely undiscovered over the period of time becomes, a reasonable name in the long term.
So you mentioned that Piyush looks after the underserved, which is a small and micro, and Prabhat looks after the super RH, which is mid and small.
So,
is that correct?
Yeah. So Vijay and Prabhat support me, on the fund management, and I oversee the direct fund management also of the, RH underserved. RH super value.
Sure. So the next question is now, how often your team visits the portfolio of the investors that is coming from one of the investors?
See, I'm saying we want to be live on the portfolio of stocks that we hold. Okay, most fund houses, what they do is, they have it exactly, all clients in a similar portfolio. So we also would broadly have that, apart from, when you start investing, or when you exit, where we may do a staggered entry, and a staggered exit from the standpoint of managing risk. Okay, so that, I think, at any point of time we would be live in terms of seeing that where do we want to exit a stock or enter a stock. If we don't believe, like I said, we have the RH pendulum, which if we find valuations as they are going up, we may want to get out of it. The example, and this is a stock that we may partially hold, but in a very small thing in some portfolios right now. Okay, is a company. So this is a disclosure, like an IRCTC, right? So we sort of held it. It did extremely well for us. Okay, and then we got uncomfortable with the valuations there. It had, in a very short period of time, given some obscene returns, and then we sort of took the money out. Okay, and so I'm saying that we would, look to be live there, and we did it in phases, and the last one, we decided to sort of move out. Okay, so that is something which we do. So we like to be live on clients' portfolios all the time.
All right. So it is done at the regular interval. And
Yeah. So on a live basis, so if we have triggers, then we take it out. We look at a long-term perspective, okay, but we track on a continuous basis. So and I think that's part of our job, and we need to look at and continue to look for risks, and maybe for factors that change.
And good thing what you rightly mentioned is your size also gives you sort of freedom to kind of do what you want to do in terms of identifying companies at an early stage of their growth curve, and then right through the entire growth journey. Number one. And number two is, because of the size, you also get a lot of time to review the portfolio, because most of them are customized also to large extent, I would say. So great.
There are, there will be customized ones as well as part of the overall.
Yeah. Great. All right. So if so there are no more questions from our end. So before we conclude, Anilji, if you would like to share your experience or any summary that, or any message for investors that you would like to leave away.
Yes, I put a slide for that as well.
Sure.
A little bit, having worked in the technology industry.
Yeah.
You like to. Okay, so just a few takeaways, in terms of saying that yes, one is we like to manage risk, and that's a core pillar of our philosophy. In fact, we recommend this for you as well as investors, right? That risk management, please bring it into your overall method that you do. Okay, while you look for, even on mutual funds or even on PMSs, you look at the return measures. Please also look at the risk measures. Okay, and our experiences, if you manage risk, it's also delivered superior returns. It's the surprising part. Okay, and especially if you are following a disciplined investment style, right? And so that really helps, where you find that structured process, or including as an investor, you could have a certain style to make it in a disciplined way, when to exit, when to come in. Okay, look at long term and stuff like that. Okay, use systematic investments where possible, phased investments. Okay, and the other part is, if you want to deliver superior returns, we think that a core part is, how do you look at the future leaders? Okay, apart from the stable ones, you may, so like almost like core and satellite. The core portfolio sort of gives you stability and risk-adjusted return. Leaders can really unlock value, and that is something. Okay, and market cycles, if you're able to study, that's the other part. It's something that has been our strength. Okay, and that's something that you could look at doing. They could also deliver very large ones, because imagine, out of the 2008 market fall, right? If instead of 60% even fell 30%, half of it, your compounding and your returns from there would have been substantial, on the upside. And yeah, so we spoke about, we also have the freedom to invest in smaller size. But the caveat and the point to keep in mind for investors is when we invest in small cap, okay, we need to be clear that they can fall also more. Okay, so for us, because we keep track of relative valuations and look at certain measures, we also pull back, from some of them, the more riskier ones. So that is something to just keep in mind and, look at it while you manage risk. Yeah.
Sure. So there are two more questions which have come up. If you allow me, can I ask?
Yes, sure, no problem.
So this question comes from Ashki Abhinav. He's saying, what's your take on fixed deposits? Because you talked about maintaining cash. So what's your views on fixed deposits?
Yeah, unfortunately, at this point of time, debt is one of the worst places to be. Okay, because the returns are very, very poor. Unfortunately, that becomes the reason why people are investing in equity. Okay, so that should not be the reason to invest in equity. You need debt, based on overall asset allocation, and especially have certain needs which are coming up, etc. Because you don't want to be held, selling at a market low, if you need money. Okay, so we think that debt will continue to, be poor. Fixed deposits will continue to deliver low returns. If you are also in the high tax bracket, then you'll probably get almost nothing, post tax, and especially if you're in the high surcharge brackets, would help you. Okay, so that's something to sort of keep in mind. So if I were you, I would also look at how do I maybe look at tax efficiency. Okay, so either through some of the debt mutual funds as an example, and even if I want to play safe, there are ones I could take which are, low risk profile thing there. At a time like this, maybe bonds may be a good place to be there. But again, you have to be very careful. What we like to tell people is that on the debt side, I want to be very cautious. Okay, so even if it delivers a lower return, I think it's better to be cautious on the debt side. Okay, so from that standpoint, like what we have looked at in recent times, where especially for, let's say, senior citizens and stuff, is including SBI, and you have bonds which are available. Tax-free bonds could be one for very, very high risk, the high tax bracket investors. Okay, so that is the one place that we have used apart from FDs to look at the bonds a little bit. But I'm just saying, be cautious. We've seen a whole lot of volatility around that. Okay, especially if you're directly investing in bonds, you should also be able to understand the quality of companies that you invest in. Otherwise, just stay with debt funds or bank fixed deposits.
Yeah, and I also would like to add what Manil is saying. Obviously, that your interest rate is low, your cost of capital is so low that you really can't make too much of money out of debt investment. So, but as a part of the asset allocation, you should do so. But at the same time, don't expect too much of returns. The next question is, do you guys help in investing MF? So I'd like to answer here that no, we don't do it. So we only focus on AIF and PMS. Not that we don't have capabilities of doing so, but we've decided not to do so. Basically, it's like a Pizza Hut where you get pizza, you don't get burgers. Similarly, we've developed and built up the platform in a way that we only essentially focus on AIF and PMS. In case you're looking out for any mutual fund guidance, you can reach out to Right Horizon Wealth Management. There's a separate vertical, I think, under the able guidance of Mr. Anil Rego. So you can reach out to them and reach to their website and speak to them, or you can speak to any of other financial advisors. The next question is, what's your views on Nifty Index Fund? So again, it's a mutual fund specific question, so I wouldn't like to take this up. Probably you can have a one-on-one discussion and take it forward. So with that, I think there are a few more questions which has come up. 1 second. So what about NCDs? Are they a safe option? Again, so that's again more to do with financial planning. NCD has two options basically. One is the secured one, the other one is non-secured. The secured one, if it is coming from good group with AAA rating and happen to know the group, and if you think that you're doing a due diligence and you find it good, then you can go ahead with it. It's a beautiful instrument, approved by regulator. The next question is, I have a home loan for 20 years. What will be your advice on managing my investment in mutual fund stock markets? My aim is to repay as early as I can, but can't compromise on monthly expenses. Would you like to answer this, Anil?
Yeah, so it's a wealth management and personal finance question.
Yeah.
Yeah, so I'll just give it at a very high level. And when interest rates are low, we think that it's also okay to have a home loan, okay, because you may be able to deliver a superior return, across other assets, okay. And normally when interest rates are also low, you find that equity markets do better. So that's the sort of the other part. It's a slightly contrarian type of view there. But yeah, so I think just doing a disciplined investing across multiple assets and having a combination of PMS mutual funds, NCDs, debt mutual funds, etc. I think it's just the right thing to do. So I think it's difficult to give a very without knowing the details to give a response to that. But other than saying, be diversified and look at all sides of it.
Sure. The next question is, what is AIF? Please expand on it. Do you have AIF, Anil, or you had before any AIF? No.
No, so we don't have an AIF at this point of time.
Okay.
Okay, so yeah, so the AIF is basically an alternate investment fund. Okay, and what the regulators have done, they've kept three levels. You have a mutual fund, you have the PMS, and then you have the AIF. So the PMS has a minimum 50 lakh investment. The mutual fund starts off with 5,000 rupees itself. And so that's for the common investor. And they graduate to the AIFs. The AIFs gives a lot more flexibility. They can even take futures and options. You may have real estate funds. You may have long short funds. Okay, so there's the regulators believe that investors who can put that type of capital can take a high level of risk, and they understand it. So sort of it is sort of restricted to them. Okay, so I think Vikas can also add on probably.
Yeah. So I would like to build. So basically, if you look at AIF, because as Anil rightly said that the minimum threshold is 1 crore over there, it's basically a perfect blend of mutual fund and PMS, I would say. So, like a mutual fund, you have NAV. Instead of having daily NAV, you have monthly NAV or quarterly NAV over there. Number one. Number two is that it works, it behaves like PMS because their portfolio manager has, as Anil rightly said, that has a lot of flexibility. So he can construct the portfolio the way he wants to. Maybe he would like to have a concentrated portfolio. Portfolio manager is free to do so. And then you have various category 1, category 2, category 3, where different sort of AIFs have been classified by the regulator and in which they kind of allowed to function. We write a lot of blogs on AIF, so you go to our website called www.aifpms.com and you'd be able to see all the details about AIF, how many types of AIFs are there, there's a listed space, unlisted space, real estate, all of them you will get to know about it. So that's it. Then the question is, I have 4 SIP. So we are not the right people if you ask me about SIPs. Okay, can you please throw some more lights on REITs? Anil, would you like to take this question? Because REITs, I mean, not that in PMS you invest in REITs, but do you have some idea about REITs? Because some investor wants to know how to create wealth through REITs.
Yeah, so REITs are basically a real estate investment trust, and yes, so that's another interesting thing that regulators have brought in. Some of these, you may have real estate funds under the AIF space as well, but REITs are mainly, rental yielding assets. Okay, another type of it is what you call as InvITs. Okay, the InvITs basically they invest in infrastructure, and REITs basically invest in real estate. Now, you have a few good REITs which are there, like Embassy. For somebody, say, he's in Bangalore, you will know that Embassy is one of the leading commercial real estate, and you actually can participate in that, which as an individual, if you ended up wanting to do a few hundreds or a few thousands of crores, you'll have to sort of spend to invest into those category A properties, let's say in a Manyata Tech Park, one of the premium technology parks in Bangalore. And similarly, there are other, they have multi-city and diversification, etc. So REITs are basically yielding assets. So you will be able to know what is the yield that comes in maybe anywhere between 6 to 7%, which is good at a current time, just from the rental or the infrastructure income that comes in from tolls, etc. Okay, and then you have the capital appreciation, but then it's listed. Okay, so you can buy it like a stock, and you must keep in mind that like when COVID came, for example, and suddenly the environment turned bad, you found losses on the capital. So the price of the REITs or NBITs ended up falling. So you need to keep in mind that that could move up and down. So it's important to time it from that perspective. But other than that, if you're looking at a real long term, REITs is a very popular concept globally, and that is something that one can end up with.
All right. Okay. With that, we would like to conclude the session. And thank you so much, Anilji, for taking the time out from your busy schedule, joining in, answering all the questions so patiently. And thank you, my dear investors, for joining in today and asking these questions. So thank you so much.
Thank you. It has been a pleasure to be here, and it was a great session. And thank you for all the interactions.
Thank you.